After spending the week here in New York with Portfolio Construction Forum's International Private Markets Short Course, what feels striking is not necessarily what markets are doing on the surface, but how different the system underneath them is starting to look. Because if you just look at price action, everything looks relatively stable. Equities are near highs, AI-related earnings remain extremely strong, semiconductors continue to lead the market higher, and investors still appear willing to buy the dips relatively aggressively. And so, but if we think about underneath that, there's a set of very different set of structural forces building. And that's both across the macro discussions this week and the private market discussions we've been having here in New York. One theme kept emerging repeatedly, and that's that the next phase of markets may depend less on simple asset class exposure and much more on implementation, quality, liquidity, manager selection, governance, and physical capacity. And that's a major shift, because if we go back and think for much of the post-GFC period, markets benefited from a confluence of tailwinds, falling rates, abundant liquidity, globalization, cheap leverage, and multiple expansion. In many cases, simply having exposure was enough. But increasingly now, the system looks more constrained. Energy security matters again, supply chains matter again, physical infrastructure matters again, and certainly liquidity structures matter again. And that's happening at exactly the same time markets are pricing an extraordinary AI-led capex and productivity boom. So we've got this unusual environment where equities remain strong, oil markets remain highly volatile, bond yields remain elevated, and geopolitical fragmentation is still building underneath the surface. And I think that matters because AI itself is increasingly colliding with the physical economy. Data centers require enormous power demand. Semiconductors require supply chain security. Industrial policy is returning. Countries are stockpiling strategic resources again. And infrastructure is increasingly becoming geopolitical. So one of the most interesting things from the private markets discussions this week was that private markets are no longer really just an alternatives discussion. They've really morphed in the wealth ecosystem to becoming a portfolio construction and implementation discussion, because the future dispersion in returns may increasingly come from manager selection, liquidity governance, operational capability, as well as implementation discipline, not simply from owning private assets themselves. And to me, that reflects the broader shift now happening across global markets. And really, the old regime was largely built around abundant liquidity and financialization. And now the new regime increasingly looks built around scarcity, infrastructure security, implementation, and strategic resilience. However, markets still appear to believe AI-driven productivity can ultimately outrun those pressures. Maybe they can, but the underlying system today feels materially more fragile, more constrained, and more geopolitically sensitive than the headline equity indices currently imply. And I think that's one of the biggest things you feel about being here in New York City. I should say these views are mine and do not necessarily represent those of the Portfolio Construction Forum or its affiliates.